What are the terms of trade in international economics? Have you ever wondered how countries decide what to trade and how much they gain from it? The terms of trade play a significant role in this process. The terms of trade refer to the ratio between the prices of a country's exports and the prices of its imports. This ratio helps us understand how many units of imported goods a country can obtain for each unit of exported goods. Essentially, it shows the relative value of exports compared to imports, giving us a glimpse into a country's purchasing power in the global market. To calculate the terms of trade, economists divide an index of export prices by an index of import prices. When export prices rise compared to import prices, the terms of trade improve. This means a country can buy more imports for the same amount of exports. On the flip side, if import prices rise compared to export prices, the terms of trade deteriorate, which reduces a country's purchasing power abroad. Why does this matter? Well, changes in the terms of trade can have a direct impact on a nation's economic welfare. If a country's terms of trade improve, it can consume more imported goods without needing to increase exports. This can lead to higher living standards. However, if export prices rise too much, demand for those exports might drop, which can affect the trade balance. Several factors influence the terms of trade, including global commodity prices, exchange rates, and shifts in demand and supply conditions. For example, a country that exports oil will see its terms of trade improve when oil prices rise. This allows that country to import more goods for the same volume of oil exported. Policymakers and economists closely monitor the terms of trade to evaluate a country's economic position in international trade. It reflects the gains or losses from trade beyond just the volume of goods exchanged. Understanding the terms of trade also helps in assessing how external shocks, like a sudden rise in oil prices, can affect an economy. In summary, the terms of trade serve as a key indicator of how favorable a country's trade conditions are. They influence income, consumption possibilities, and economic strategies. By keeping an eye on these terms, countries can better navigate the complexities of international trade and make informed decisions that benefit their economies.